Hey everyone, we are here with JK from Stakefish. He'll be doing a talk on the convergence of ETH staking and DeFi. And I'll let him take it from here. Questions go in the Ask a Question section at the bottom. Thanks.
Awesome. Thank you, Sinju, for introducing me, and thanks for putting together this wonderful conference. Seriously, amazing speakers all around, and it's been pretty packed set of talks. Let me start off by sharing my screen. Then let me get started. Just to introduce myself, hi, my name is JK. I'm heading the strategy and operations at Stakefish. Stakefish is a validator, and we've been in the validator space for 2 years now. We've been participating as validators on various proof of stake networks. But also, we've also been supporting essential applications on Ethereum, such as Chainlink. And so we've been pretty excited about Ethereum 2.0. We've been heavily heads down focused on trying to develop our own solution around this for the past few months. But today, I will talk a bit about that near the end. But today, I'm here because I primarily wanted to talk about how Ethereum staking is going to converge with DeFi. Let me start off. So Preston, thankfully, gave a great presentation right before me explaining what Ethereum 2.0 is. So I think most of the people here have got the gist of what Ethereum 2.0 consists of. You might also well know that the Ethereum 2.0 is imminent. It's going to be here soon. But what that means is that we're starting off with phase 0. With phase 0, we're going to be introducing the beacon chain of Ethereum 2.0. And this marks the beginning of the transition to proof of stake. So what does this mean? This means that instead of miners who are adding blocks, verifying blocks, we have validators now. We have a different set of stakeholders who are in charge of the security of the network. And instead of mining equipment, you just need some ETH staked. You need 32 ETH and some hardware lying around that you could leave online, whether it's an old laptop, as Preston mentioned, or you could buy a Raspberry Pi, or you could just sign up with a cloud service. And most importantly, miners were the only ones getting block rewards for their service of providing security to the network. But instead of these block rewards now going to miners, we have something that's called staking rewards for validators. And so this is very exciting because now earning newly issued ETH is no longer in the hands of miners. Anyone with ETH now can participate and earn staking rewards. And so it marks a really huge transition of the economics of how the Ethereum ecosystem will work. And so people have been questioning me a lot, asking me a lot about whether we're really launching this time. I'd like to answer yes this time around because there's really hard evidence of the imminent launch. For example, the latest testnet, Zinken, has run without any major hiccups. And this is a big deal because we've been a part of multiple launches of other networks, and it's very difficult to see a testnet just launch without any major hiccups like that. And so we see this as a significant step towards the right direction. And we do see that this signals the fact that the Ethereum 2.0 clients teams are ready. And then also there are indications that the deposit contract is planned to be deployed any moment. And we're talking about 1 to 2 weeks from now. And so with the deposit contract finally live, this marks the countdown finally then starts towards the beacon chain launching. And so I've made a big deal just now about staking rewards, and I think that's primarily one of the reasons why a lot of people are excited about it. But how much staking rewards are we exactly talking about? And that's sort of what I wanted to start off this entire talk with first. Because staking rewards, in a sense, could be considered as part of DeFi. It's a way to earn more ETH on your ETH. And so while there's contention on whether it of in itself is yield interest or DeFi of itself, regardless, people are just fascinated by the fact that you can earn more ETH through ETH. So let's just try to dive into how much more ETH are we talking about? What is the staking reward rate we're talking about? So I've I've calculated this graph. So on Ethereum 2.0, the staking reward rate, how much ETH gets released to ETH stakers, depends on how much ETH is being staked on the entire network, which we call the staking ratio. The staking ratio is equal to how much ETH is staked over total circulating ETH. And so you could see that it starts off. So at a minimum, Ethereum 2.0 needs at least 0.45% of the entire current ETH circulating ETH stake in order to start. And so once that amount is hit, you could expect the reward rate to stay around somewhat around 20%, which is insanely high, especially considering that you're earning 20% on your ETH. This is a reward rate that's probably not available anywhere else on your ETH. But it's very unlikely that the reward rate will stay at that point, and it will start decreasing pretty rapidly. And then, I don't expect it to happen. But if in any scenario, 100% of all ETH get staked, you can expect somewhere around a 1% staking reward rate, which is still decent considering that some of the major DeFi protocols offer interests that are lower than 1% on your ETH. So I'd say it's still relatively a competitive rate. Now, the next thing I wanted to do was, so you see this beautiful graph, but I'm talking about a staking ratio of somewhere around 0.45% to 100%. It's hard to estimate out. You definitely would want some sort of narrowed down numbers of where your staking reward rate should converge on. And so I've taken some industry benchmarks. So let's take first as an example, let's look at the top networks, proof of stake networks. And I've taken some of the a select few proof of stake networks that have at least $1 billion of market cap, and I've looked at their respective staking ratios. And they all are relatively high, well above 50%. And then I've taken the average of those, and it's given me a 68% staking ratio. And so, assuming that Ethereum 2.0 ETH staked reaches the staking ratio ever reaches 68%, the staking reward rate on Ethereum 2.0 will be somewhere around 1.3%. So that's one range we could start things off with. Now, the other side of this is that it's arguable that because there's a lot of DeFi protocols out there, lending protocols out there that give you interest on your ETH, you as a rational actor would choose to deposit your ETH on a DeFi protocol rather than stake them if the interest rate was higher on a DeFi protocol. So I'm just assuming that the markets for staked ETH just converges on the average interest rate that is available for DeFi protocols on lending protocols today. And I've taken the most recent interest rate for each of these DeFi protocols, and I've taken the average, and it sits somewhere around 2.96%. Now, assuming that the staking reward rate would have to converge to 2.96%, the staking ratio of Ethereum 2.0 would lie somewhere around 20%. Now, taking these ranges of a lower range of staking ratio at 20%, and then a higher staking ratio of 68%. You could see sort of the staking roll rate should sit somewhere around 2.96% to 1.3%. And just for example's sake, I've also taken the midpoint to show you that it could just taking an average of these two, the reward rate could sit somewhere around 2%. And so, considering the available lending protocols out there today, a staking reward rate of 1.3% to 2.96% is arguably still very competitive with DeFi protocols. And so staking rewards are likely going to be a huge part in DeFi. There will be a lot of people that will be assessing that staking ETH is probably a better option for their long-term hodl the ETH rather than leaving them on lending protocols. And if you don't like sort of the estimates I've put out there, you could, of course, try to calculate your own staking reward rate using our calculator on our website. I highly recommend just checking it out, playing around, and try to plug these into your own models such that you make a rational decision once phase 0 launches. And let's assume that you have decided to stake ETH. There's three options out there. One, you could run your own validators on your own machines. You should definitely practice this to determine whether or not you're able to do this. You could also, of course, stake through third-party validators like us, like stakefish. Or you could use decentralized staking pools, and decentralized staking pools are cases where you could stake with less than 32 ETH because your ETH is getting pooled with other users, other holders of ETH. Now, great, you can stake ETH, but the big question is that it? Are staking rewards the extent of our staking rewards is that it? Is there nothing more to do with DeFi? Well, the question you should obviously be asking is, there's a ton of great DeFi protocols out there. Is there any way at all to combine staked ETH with the existing protocols? Use the composability aspect of these wonderful DeFi protocols out there. And those of you who have been involved with DeFi know that DeFi has been on hypergrowth. Just this year, I remember that it was just this in the past year that we've passed the $1 billion mark of total value locked in DeFi, and that was such a big deal then. But now we're easily well past $10 billion and growing. As a staker, you would obviously want to be part of this DeFi ecosystem. And a key component in the growth of DeFi has been ETH. A lot of the lending protocols, for example, require collateral, and ETH has been the collateral of choice for most of these lending protocols. And then also some DeFi applications like DEXs, like Uniswap, for example, uses ETH as a common base asset to trade between ERC20s. And so the vast majority of these DeFi applications have been choosing ETH as the collateral of choice. And yeah, I've already talked about Uniswap, but I've also missed out on MakerDAO, obviously, which is arguably one of the earliest DeFi applications of them all. And the very first collateral you could lock up there was just ETH, just locking up ETH to issue DAI. And I've added also a bunch of other examples, like, for example, Nexus Mutual, where also you have to lock in ETH to pay for cover. And then also some asset management related DeFi applications like the Wire and Vaults, where you could lock up ETH and it will automatically allocate ETH to other DeFi applications to earn more interest on your ETH. And this is just a short chart, a succinct chart, just to show the popularity of ETH as collateral. These are the DeFi applications with at least $1 billion of value locked in each of them. And you could see that ETH on MakerDAO and Uniswap obviously is one of the has a big, huge chunk. It takes a huge chunk of the total value locked in each of those. For Compound and Aave as well, arguably. For Compound, the ratio it might seem low, but it's extremely high, considering that at least $1 billion of the total value locked on Compound is mostly coming from DAI being locked, borrowed, and then locked again in Compound. And then for Aave as well, the only assets that are used as more collateral than ETH are wrapped BTC and then Link. So I've shown the popularity, but let's take a look at just the total hard number of how much ETH is currently locked up in DeFi. This is not the entire universe of all DeFi applications out there. I've taken some of the ones that have a ton of ETH locked in them, and I've calculated that roughly about $3.3 billion worth of ETH, or 8.25 million worth 8.25 million ETH is currently locked up. And so there's a ton of ETH being locked in each of these DeFi applications. So there must be a reason why I'm bringing this up, obviously. And let me talk about where staking would fit in to all of this. To talk more about that, I need to dive into what decentralized staking pools are. Decentralized staking pools are non-custodial staking pools that matches ETH holders with arbitrary node operators. These will all mostly be coordinated through smart contracts on the proof of work Ethereum chain. So the current Ethereum chain that we're all using right now. A few key aspects of these decentralized staking pools are that the withdrawal keys will be managed in a non-custodial manner. There's different designs out there that are being put in that are being worked on. I won't go into here for now. And then any amount of ETH would be able to be can be staked on staking pools. That's the whole beauty of staking pools. If you have less than 32 ETH, you can find other holders of ETH that have less than 32, and together you're able to co-own, cooperate a validator. And the most important part that I'm highlighting with unicorns here is that the staked ETH will likely, very, very likely, be tokenized as an ERC20 likely on the current proof of work Ethereum chain, and essentially making them liquid. Currently, if you choose to stake ETH, right now it's a one-way bridge. So you move your ETH from the current Ethereum proof of work chain to the beacon chain, and you lock it there. You cannot move it back, and withdrawals are not enabled during phase 0, which means that even if you have ETH staked on the beacon chain, even if you try to unstake and move it around, you simply cannot. You'll have to wait until at least phase 1.5 when withdrawals are planned to be enabled. So that's a huge problem for, that might not be a problem for holders of ETH who are, who just want to stake and just don't worry about it. But for people who are trying to find the most optimal strategies on how to allocate and manage their ETH, this is a huge problem, which is why the tokenized staked ETH idea mitigates this problem. And the tokenized staked ETH, in my opinion, of course, is going to require some time to become widely utilized. Of course, there will need to be smart contract audits on the on how it's designed, and the staking pool designs architecture also will need to be time tested. For example, like if there's any aspect of a staking pool design that falls apart, it's going to lose trust from the community, and therefore that would mean a huge drop in demand. And so you definitely want to see a bit more of evidence that the pool architecture, staking pool architecture, is working as intended. Of course, you will also need to see consistent demand for a given tokenized staked ETH. You'll also need to see some liquidity, because if there's no liquidity, what's the entire point of just having a tokenized staked ETH? You want to be able to have, you want to be able to see deeper books, such that you're able to optimize your tokenized staked ETH. And then you'd also likely want to see some consistency on Ethereum 2.0, such that you can be assured that your tokenized staked ETH is consistently earning staking rewards. But my expectations are that slowly some of these boxes starts getting checked. People will feel like there's zero reason not to stake ETH, and especially if you are a long-term holder of ETH. And here's where I expect. Here's my expectations in the next 6 months to a year. And I strongly believe that a lot of the ETH that are just sitting on DeFi protocols, locked in DeFi protocols, will likely start being replaced with tokenized staked ETH. And this is the graph, the pie chart I've shown earlier, which I'm bringing back up again. And the question here is not about just simply about how much of this, how big will this pie grow, but how much of this pie will look different in a year from now, because I do expect that a huge chunk of this pie will consist of now tokenized staked ETH rather than just vanilla ETH that's not earning any staking rewards. And I truly believe that staked ETH, especially tokenized staked ETH, will become the next foundation for DeFi products. And so if you're a DeFi application and you're not, you should definitely be trying to fit in Ethereum 2.0 into your roadmap, not just in terms of technological adaptation, but also considering how staked ETH could fit into your stack. And there's a similar lesson here for users as well. And it's a good time to consider whether or not you should be joining decentralized staking pools or going with just locking them up without any tokenized stake Ds. And so, regardless of who you are, I think you should all be, if you're holding ETH, you should all be really looking into Ethereum 2.0 and start making your decisions right now. And this is where I also am happy to announce that we ourselves, Stakefish, is also launching our staking platform. I won't go into all the characteristics of our staking platform. I'll leave that in your own time just to read them. But essentially, our staking platform is going to be one of the third-party staking validator platform solutions out there, where you generate your own withdrawal keys. We don't take any custody of them. You deposit your ETH, and then we take care of the rest. And believe me, when we say take care of the rest, there is a ton of effort and time that goes into it. And with that announcement, I'm also happy to announce that our platform is open for early testers. We've really rushed really hard to try to get this ready for today. And so we're currently encouraging people to sign up, such that we'll also be able to help out with the Medasha resurrection right now that's going on. So if you're interested in trying out our platform, please reach out to us at eth2@stake.fish. And we're happy to help you interact with our platform, and we'd love your feedback on how we've built this out. So I've talked today about how DeFi and Ethereum 2.0 will likely converge, likely through the tokenized staked ETH. And I'm always happy to talk more about my ideas here, and then about what I know on this front. So feel free to reach out. You can reach me at my email or Twitter. And I'm quite sure I'll make sure these slides are available for everyone after this talk. And then let me get to questions if there are any. Let's see. So the question is, what are the benefits of testing the Stakefish platform? So I won't go into. I'm gonna stop myself from saying what the benefits are. I think it's just so that you're able to conduct your due diligence, I think, is the most important part. You'll be able to see how our dashboard and our platform feels and compare with other platforms out there. There's a few really great contenders out there. I've already posted a Medium article, highlighting these other third-party validators and staking pool solutions. So we're just throwing our hat in there. I definitely think I definitely want to make sure that our platform is competitive to you, and I just want to make sure that you have the option and you conduct adequate due diligence on which platforms suit you best. Then, are there any other questions? Thank you. I guess if there
I have a question, actually.
Yeah.
So regarding different staking as a service providers, I know VC firms and companies actually think about them in terms of location, so geolocation, due to different regulations. So do you have any strategies based off of conversations you've heard from talking to different people? Or how do different people think about it, maybe?
Yeah. Well, I could answer. So you're perfectly right that the people are conducting strategies around regulations, and I think what we've been seeing more and more is that people are just trying to stick to their local regions. So meaning that you're trying to interact with providers of a similar region, rather than trying to go with a service provider in another continent, for example.
Are they doing that for localization reasons, or is it for something else?
just primarily because you're able to then, you have nexus in the same region, right? At that
Got
point.
it.
And so I think people, at least the VC funds, a few funds we've talked with, feel more comfortable with the fact that they're able to they might have some legal, say if they interact with a service provider in the same region.
Okay. I know for some other layer ones, changing from different validators once they do stake is actually very challenging. For Ethereum 2.0, like how is that set up for different validators? I'm actually not sure, which is why I'm asking.
Yeah. So yes, you're right in that a lot of the current existing proof of stake layer ones, you don't see a whole ton of churn. You see people just sticking with the validators that they've chosen at first. But I think that assertion is still yet to be seen. What I mean by that is if you, for example, look at Tezos, which is one of the longer running proof of stake networks, the entire validators landscape have changed since its first launch. So I do slightly contend that. I just think it needs more time. Now, just to answer your question about Ethereum 2.0, it is a lot more difficult to change your service provider. I've written a few articles warning about this because whichever validator you choose right now, you're locked in until at least withdrawals are enabled. That could be at least a year to a year and a half out from now.
So does ETH2 have slashing where you can potentially lose your tokens?
Yes, absolutely. And I think more importantly, it's not just about losing funds, but once you get slashed, you are exited out of the active validator set, which means that, just a reminder, withdrawals are still not enabled. So once you're kicked out of the active validator set, you have ETH sitting on your validator address that cannot even be withdrawn. So you're in a more serious scenario where not only did you lose ETH, but you've lost liquidity and you've lost the opportunity. You just have ETH sitting around doing nothing, basically, that you can't even interact with any DeFi protocols existing out there, that you can't even move to an exchange.
Interesting. Interesting. I know lots of people that own a lot of stake sometimes think about staking across multiple different validator, like staking as service providers to basically minimize risk. Is that like even realistic, or is it better just to go with professional validators? Because I'm sure you talk to a lot of different people, so people have different strategies.
Yeah. So we've seen two strains actually. We've seen people that do diversify, yes. But we've also seen people that choose not to diversify and just try to lock in a service provider through legal contracts. And what that means is just making sure that the service provider is on the hook for any problems, basically.
Okay. I think you have a second question.
Oh, I do. Oh, why are withdrawals disabled? So definitely a question that I think is better asked for the client teams, such as Preston, I think would be the better person to answer to. But just based off of what we've seen, at least from other protocols, teams feel a bit more comfortable going with limited functionality at first and then slowly rolling out additional features on the chain. That's why you see a lot of newly launching chains launching without any transfers enabled. And then slowly rolling out transfers. So there definitely will be some similar reasoning behind this, such as that. But also, I recommend definitely talking with the client teams on that one.
Is ETH2 non-custodial staking, or is it custodial?
So that depends on the withdrawal keys. So on ETH2, there are two keys. Okay. One is a signing key, which conducts the validator operations, and the other is withdrawal keys, which controls the flow of funds in and out of an address. And so when people say non-custodial, I expect it to mean that the users hold the withdrawal keys. Once that withdrawal key is given away, I no longer consider that non-custodial in my opinion.
So with ETH2, have they figured out which direction they're going in, or is it just kind of depends on the validator provider?
Oh, I see what you're saying. So is delegation basically enabled?
Yes. Yes.
I've had a long talk about this with, I think, Prismatic Labs about this at one point. Unfortunately, delegations are not available.
Okay.
And so, which is why the stakes are extremely high.
Got it.
You need to find a third-party validator service or the staking pool that you can trust if you are not going to run your own validators.
Got it. Interesting.
Stakes are high. Extremely high.
Yeah, indeed. I've talked to the team before, like back in February, and I think like they have to hit some threshold of like ETH before like the network can launch. So it might be that. Is it, or is it?
No, that's just a minimal. So, in order to make sure that none of the consensus doesn't break down, there's a minimal number of validators that are required. So this is just more for the security of the network, the minimum amount needed, rather than anything else. That's the base consideration for that.
Very cool. So I think we're at time. Do you have any final thoughts or words you want to share with the community?
Yeah. So I mean, to the community, like definitely pay a lot of attention to Ethereum 2.0. It's really here. It's going to happen in a month or two. Definitely think about your strategies. But then also the other part is, Sunju, thank you very much for putting this wonderful conference together. I can't believe you're
still alive.
Put together all of these, amazing speakers. But yeah, thanks for inviting me here.
Yeah, thank you guys so much for sponsoring as well and for participating. All right, I'll let you get going, and we'll see you all tomorrow at 9 a.m. Fluffy Pony from Monero will be speaking. Tomorrow's talk will not be about DeFi, which is great, just for a day, and it'll be around financial privacy and zero knowledge proofs. So see you guys tomorrow at 9 a.m. Bye.